Alex, as ever, fantastic to get you on Real Vision.
Thank you. Great to be back. Always excited to talk to people over there at Cayman Islands enjoying life.
Yes, we've just gone through another phase of quarantine and borders being closed, so I've not left here yet. So listen, Alex, I want to get your updated thoughts. It's been a while since you and I chatted properly on camera to just figure out where you think we are in the cycle. That's the kind of big picture, and then we'll dig into a whole bunch of stuff. Where do you think we are? How are we allocating capital in this kind of environment? Because it's not the easiest environment.
It's not the easiest. If my best guess, we're in 2004.
Yeah.
Like, why do I think we are in 2000? I'll get back to you on this a little bit more. But why is my best guess 2004? Well, we went through maybe in a little bit compressed schedule, but about a year and a half, we went on a catastrophic event, which is interestingly corresponded with slowdown in economy and rate decreases that were happening anyway. That was the case in 2001, and that was the case in 2019, 2020. We were already in it's weird how history repeats. Like, there is some kind of magic to that is very hard to explain.
I know, because it was slowing down beforehand in all of these cases, and then suddenly an event happens. It's kind of weird.
People are saying, like, so inverted yield curve predicted recession once again.
Every time, and everybody argues with you every time.
And I've actually written about inverted yield curve, and I talked about how it is a little bit of the predictive power of inverted yield curve is a little bit misunderstood in the sense that there is certain concurrency to it. As I said, if you fall off the top of the building and you're from the 20th floor and you're flying by the 10th floor, it's a very good predictor that you're going to hit the ground. But the fact that you fell off is really the predictor. So inverted yield curves happen when there are certain things like tighter monetary conditions appear. And those are symptoms like flying by the 10th floor. But by themselves, it's not that it's really predicting recession. It's more like it's one of the things that happen when they go at the late stage of business cycle. But it's a very observable thing. And that's why people use it as predictor. But like how inverted yield curve predicted COVID, I still don't know, right?
I know. It's magic, right? So you're talking about 2004, which I share that belief, whether it's 2004 or 2003.
Yeah,
it feels like something around that period. What I've tended to notice at early stage recovery, we tend to have a slowdown for a period of time because people over extrapolate growth. What do you think about that? Is that on the cards this time around as well, where yields fall a bit, it's a bit more risk off in certain environments before we gain full traction? How are you thinking about it?
Well, the interesting thing that in 2000, with the last cycle, there was a double D bottom economy in the stock market because it hit actually the bottom, depending on how you look at it, in 2002. So even though 2001 was like the first sell-off, and the rates hit the bottom in 2002, if not 2003, even, like, I don't remember when exactly. I think maybe spring 2003 when we had a big flattening rally, and then it kind of very similar to what we had in towards the end of 2020, and then there was a big steepening sell-off in the summer to fall of 2003. Another interesting characteristic that aligns those things is the precious metal behavior. Precious metals were really depressed up to 2002. They started to rally in 2003, and then in 2004 they stalled for about a year in a pattern very similar to the current pattern. So that is what kind of puts me there. In terms of economy, I feel like predicting how economy behaves is harder than to predict asset prices. So I usually kind of circuit the economic and inflation predictions and go right to the assets. And we can talk about that a little bit, about my thinking about assets. But there might be some arguments to see why we would have a slowdown. Well, I don't know if at some point stimulus will expire. There is also something to look at that paradoxically during 2020, we had a rise in real disposable income because of all the stimulus and the inflation was negative. Now we actually have year-on-year negative real wage growth because inflation is so high. Wages are growing high, but the real wage growth is negative. And again, I'm not an economist to really know how important it is, but from the very top layperson's consideration, negative real wage growth is somewhat contractionary, right?
Yeah, and a lot of the forward-looking stuff that I look at just suggests, as typical at early stage, that we might get some slowdown. And the bond market, kind of flagged this a long time ago. As you said, the bond market figures this out a long time ago. How are you reading the bond market right now?
Well, I'm generally constructive on duration globally, even though I think there are spots to be short, but I'm constructive on duration. And maybe US bond market is not my favorite right now. I still like better the down under bond market, Australia and New Zealand. In the long run, I feel like there's steeper yield curve, less of that kind of huge fiscal rebound structure, and more of a like steady riding to zero, more contagion from China, a lot of things that might keep them at zero for a very long time. And also, I feel like in the inflationary scenario, those currencies will actually perform well, which in itself put downward pressure on the inflation.
Yeah,
But
makes sense.
even US bond market, we're seeing it kind of chopping without too much direction right now. I feel that the big crazy rates go to zero rally has happened in 2020. That's kind of like 2002, beginning of 2003. Then we did have the big rinse out, people got over their skis, sell off. And those are pretty common. Those happened a couple of times actually after 2008 crisis too. There was one big sell-off in 2009, and there was another, probably like one or two big ones, including the so-called taper tantrum, which actually was more protracted than it sounds like. It was kind of also double dip sell-off in 2013, beginning of 2014. But I felt like this stuff, at least for now, this bond market rinse out is out of the way. And now we are more likely like in a stage when it will have to be policy that drives yields higher. And interestingly, when policy tightens, that actually historically leads to lower yields, which makes sense actually, because bond markets are not driven by supply. This is one of the mistakes I think, and I actually don't know why, but I have some suspicions why, but I'm not necessarily. It's somewhat counterintuitive because a lot of people think like this: there's going to be a lot of bonds for sale, yields will go up, and it just never works out. And historically, when you look up at supplies of treasuries and their correlation to yield, supply of treasuries was very, very low in the year 2000. And yields were very picked out when the supply of treasuries bottomed out. Supply of treasuries was tremendous, and yields would go down, and the tapering leads to yields going down. So it's not about supply; it's about path of policy.
Generally, the same is true of QE as well. So in periods of QE, yields go up. In periods of less QE, yields go down.
Because it's all about the path of policy. The thing is like tapering is tightening it, or tapering or reduction of balance sheets replaces the necessity for actual rate hikes. Theoretically, the Fed could go through the whole thing without touching interest rates. If they choose to, and this is a whole separate debate, I don't know how they will choose to do it. There may be different options, but I think that's what I would have done if I were in the driver's seat. I would just say rates are not going up till we reduce their balance sheet substantially. They can achieve any amount of tightening monetary policies, fight off any hyperinflation just by selling off their balance sheet. Will it cause some RICO panics and squeezes? Yes. That's the whole point of tightening liquidity. Punish people for over-leveraged, right? If they feel the need to do so, they don't feel the need to do so yet. But if they feel the need to punish over-leveraged people, if they feel the need to tighten monetary supply, they could just run the reduction of their balance sheet. And whatever this business cycle is, they have plenty of balance sheet to reduce to take us through this entire balance sheet without ever having to touch interest rates. Or they might be able to take them like to 25 to 50 basis points just to make money markets operate a little better. But like they don't really need to take losses on their portfolio and take interest rates to 2% again.
Let's say they're going to start tapering this year. That probably causes a bond market rally, no?
Probably.
Because that's a tightening of financial conditions. And with the debt burden like it is, every time you tighten conditions, yields fall.
Yeah, that's what I think. I think, well, some amount of tapering at some point is expected. And tapering, like as I like to say, when you are riding downhill, we're pushing on the gas, and tapering is just pushing on the gas a little less strongly, right? In terms of expanding balance sheet and expanding monetary base. They're still accelerating. They're still buying stuff. Like, so they have to go from tapering to neutral policy to stopping repurchases. Not even getting to active selling. They didn't even get to it in 2018 to actively selling anything. They never had a chance. And the rates, 2.25% interest rates, and stopping repurchases basically broke the wheel, right? I think this time it'll break even sooner than that, because every time, I like your theory. This is actually kind of your argument that I've heard, that as debt burden increases globally, it takes lower and lower interest rates to break things. Like, as in every cycle,
yes, I think so. I mean, that's
out a little less higher.
Yeah, and that's why that chart of truth, the 10-year bond yields works all the time, is because every time it goes up to that lower, the range goes down over time, but every time it gets to the top, something breaks and yields come lower again.
So I think the interesting part of this equation is that tapering, if like stronger tapering than expected, probably will be incrementally positive for the dollar, which is very interesting because, and this is where I'm a little ambiguous on dollar, because in the cycle of 2004, tightening actually was not positive for the dollar. In fact, tightening led to weaker dollar, but tapering led to stronger dollar in 2014. So what are we gonna do in terms of and actually, like, dollar technically, usually, dollar does tend to perform weak into the end of tightening cycles, like hence dollar sell-off in 2008, early 2018, for example. So are we long dollar? Are we short dollar here? Honestly, I have very little dollar position right now versus other currencies. Like, I mean, I have some positions, but I don't have very little of like, I am long dollar versus other currencies, which was very central thing to my portfolio for like almost the whole basically decade of the 2010s.
Yeah, I mean, the dollar trade has been frustrating because it's kind of not going anywhere. And there's a lot of people who are hugely dollar bearish. I've been dollar constructive, and neither of us have won that argument because it's gone nowhere. Somebody raised a point with me that I thought was interesting. It was James Aitken I was speaking to the other day, is maybe the PBOC's balance sheet is what's causing this massive reduction in dollar volatility, because they're kind of keeping all of this basket in line. I thought that was interesting.
I don't think you can, even PBOC balance sheet can control dollar volatility. My first reaction is that could be a factor, but you cannot dump on dollar volatility even with that size of balance sheet. It's such a big, broad market, even incremental changes to the balance sheet, it's hard for me to imagine that it could completely dampen dollar volatility. But I think there is just a genuine period of, and it's not really that long. People think like, oh, dollar is not going anywhere, but that's been a year. A year is not very long for super trends, right? So we're talking about decade-long bull markets and bear markets. If, for example, dollar bears are correct, and we're like in dollar bear market similar to the 2001 to 2007, that would be like a 6-year bear market, and arguably you could even take it a little further, right? And so 1 year of stalling doesn't really mean anything. I mean, the interesting thing is precious metals. I mean, I'm biased towards long precious metals, because in precious metal space, I am thinking of still more like 2004 pause on precious metals. And that is very consistent with that pattern ramping up for the next big push up. And kind of the logic there is that you might not necessarily be bearish dollar against other currencies because they're all kind of racing for the bottom with expanding their balance sheets. But precious metals might in the end win. And the risk reward seems to be good.
And how do you deal with the fact that I agree with that point of view, but gold's bloody frustrating because it kind of just trades badly. It's a big consolidation, so it's not catastrophic, but it just trades so badly. It's difficult to do anything. Do you have a position, or do you just wait for a breakout and then get involved?
My solution, I always have position.
And just size it accordingly.
And there might be a time when, say, for example, if I need to reduce because portfolio needs risk reduction, I will reduce. When the portfolio needs, when I have risk space, I might add on the dips. But fundamentally, as I'm holding position, I'm in this for a long haul. Gold may be actually not necessarily my favorite. I mean, I think platinum, silver, some mining stocks, but it's kind of I have a spectrum of investments there. But I like to talk about silver because silver is quite a bit off its highs at like below $23 today. And yes, it has been like at $12 during 2020 crisis, could go back there again, but it's been like in the 40s in the past. And there is really no reason to believe that silver cannot hit new all-time highs within the next few years, right?
What's your thesis behind the precious metals? Is it the central bank balance sheets? Is it reflation? What's your core thesis?
More than anything, just historical pattern. There is hundreds to thousands of years patterns of how they trade. I don't view them as an inflation hedge. I don't view them as a risk hedge, even though they might perform well in some kind of geopolitical shock. But I would not. I view them more as like liquidity hedge. Liquidity at some point, liquidity will become excessive. There will be a lot of cash in the system, and people tend to put some of it into precious metals, and they are not that wide supply. And then from time to time, some of the also for things like palladium and platinum, industrial cycles change, and demand sooner or later rises when one of them gets cheap. Like platinum is pretty cheap now; it'll probably go up at some point, one way or another. They'll find a use for it. Probably silver too, but silver is not super cheap. But it's more like just close your eyes. You don't know what is really going on, and who's gonna be. It's very hard to like, oh, this central bank will buy, or this like today we had news, I think today, that like BlackRock exited gold, right? And like, oh, okay, sell gold because such and such play exited gold. Those are gonna shake markets up and down on a daily basis. But in the long run, you just have to look at over a few years, where has it been? Where could it possibly go? If you think silver can go down to 10 or up to 60 in the next few years, I think it's a good proposition just based on historical pattern.
And what's your time horizon for this precious metals trade?
Till they get there.
Nice response.
I had that conversation in 2003 at JP Morgan when I bought a whole bunch of palladium at $200 an ounce. And every few months, the management would ask you, well, how long are you planning to hold it? And I was saying, till it gets there.
I like it. Yeah, and the risk reward looks great. So dollar view, you're kind of neutral right now. Rates, you think rates are probably going to come off a bit. So, yields fall a little bit, but it's no big trade, right? Is there a trade to be done or not really?
I don't think it's a huge trade in the US because, again, if you follow historical pattern, we probably will have a few growth scares that will push rates lower, but sooner or later, then this is where the question is. If you think that Fed will just be operating with tapering, you could be very bullish on every part of the curve. If you think at some point they will tighten, maybe 4 years down the line, then you kind of have this natural steepening view, right? That you're all the front end of the curve. I am very skeptical. Where I have slightly divergent view, I'm very skeptical of possibility of Fed tightening in the next couple of years.
Yeah, I would hold that view too. So the other one we got is precious metals. Well, how are you looking at China right now? Because that's, there's a macro story there because it's been slowing significantly more than any other country. How do you fit that into your equation?
Well, yeah, China, I'm thinking a lot about China now. It's very hard to know what's going on there. And so many people, including myself, have tripped up on China over the last 5 or 6 years.
Everybody has. None of us have got it right.
One step forward, you got one thing right, and you got another thing wrong and give it all back. So there were several times I was tripped up on China. So I'm a little not burnt. I don't feel discouraged. I'm not scared of financial markets. That's one thing that I can tell about myself. One advantage I have to have because maybe experience or just I'm not afraid of the market. Does it make sense?
Yeah, it does, because you've got enough experience to know how to deal with market conditions. Yeah. So it makes you less scared.
You do what you think is best, and then you either make money or you lose money, and then you manage your positions in your P&L, right? So I'm not scared to do certain trades, right? It's more like I'm just recognize my lack of full information rather than being afraid to invest. Now, my feeling is that, again, there might be contagion from China slowdown to areas like Australia, New Zealand. That's kind of a classic way to play it, very easy way to play it. There might be, typically when superpowers start economically slowing down, it might lead to geopolitical destabilization because they kind of start panicking and realizing they need to do something. Whether China in that desperate situation or not, I don't know. It also could lead to eventual currency devaluation, which people talked about 6 years ago unsuccessfully.
We've all tried that trade.
Well, and it worked in 2015 really well, and then it didn't, and it worked until it didn't. And depending on when you took profits or when you doubled up, you could have been a huge winner or huge loser, right? If you did it just the right time in 2015 and took profits right away, I think few of us played it that gracefully. Definitely not me. So there might be some interest in that trade, but as you know, I don't particularly like negative carry trades, like betting directly against China. But I think this is one of the interesting arguments for potential low global bond yields. I think China's significant slowdown will not be great for global bond yields.
Yeah, and I think what I like about the bond yield view that you've got is it's very out of consensus. Every single person I speak to is an inflationist. How are you thinking through the inflation element of that?
Well, inflation is a very difficult dichotomy. And it's one of those dichotomies which I chuck into the area of unresolvable intellectual arguments. And what I always like to talk, if you don't mind, I want to talk a little bit about meta thinking here, because I love talking about meta thinking.
Yes, please.
There is one level of thinking when people form the view, and you could see those things on Twitter. Oh, if this asset drops below 20, it's all over, right? Or whatever. Like, oh, this has to go up. There is no choice, right? This is kind of like, you read this and you say, oh, to be young again, right? There is a second level of thinking when you say, you realize, okay, I did my best research. This is what my strategy dictates. I fully understand. I will listen to that position. I fully understand that I can be wrong. If trade goes against me, I have my exit parameters, or maybe even other people convince me that I'm wrong and I'll get out of the trade. But for now, it's a probabilistics game. You realize that the best you can be like 80% sure of anything, right? And then, but there is a third level of meta thinking that I think few people engage in. So imagine that you have a view on inflation right now. Imagine, say, that I'm in a camp of moderate inflation. I'll explain in a moment why. But I put together all my charts and parameters and historical views and analysis, and I have a convincing view. But then there's a whole bunch of other people who put the charts, analysis, parameters, and they have a convincing view that we're heading towards hyperinflation. So the meta question is, why my conclusion has more weight than the other people's conclusion if you step outside of my mind and their mind and become a third neutral observer, like an alien looking at the Earth? Will there be inflation on Earth or not? So how would that alien decide who is smarter, who has a better view on inflation? And this is an area which I don't think there are other areas in which I have a trade idea, and I think I have a meta argument why this trade idea is irrefutably positive expectation. And an alien would understand it, a space alien, I mean, right? But when I'm arguing about inflation, I don't have that meta argument that I have more information than others on the subject. So I think there are conflicting camps with very strong data and strong arguments, and it's not intellectually resolvable. So we're just going to have to see what happens. And we're going to have to trade through this, try to choose asset classes that will navigate through this. And that's part of the reason I was such a huge fan of inflation index bonds over the last year. Because if inflation is high and it runs ahead, well, great. We're collecting inflation and funding at Fed funds rate, which in hyperinflationary scenario probably will be way behind inflation, right? And in inflation, if we're modeling through, like say if the inflation is 1.5% or 2%, Fed will probably keep rates at zero, and we'll have negative 1.5% real yield, which is still lower than the current real yield in 10 years, which is negative 1%. So we still have things to go and good carry to make. And then the only scenario that in which you might lose money is if inflation kind of goes to like 3-4% range that Fed considers to be dangerous. And to get to positive real yields, the Fed will have to stamp it out by going to like 5% rate. But that goes to your chart of truth argument. I think this will be very short-lasting adventure.
Yeah, you'd break the entire world if you went to 5% rates.
So if that is your argument, that if you break the entire world, if you go to 5% rates, then what do we have to fear in terms of real yields? That's my question to everybody. If you stipulate that rates cannot go that high, then what do we afraid? Because we have, if inflation is below 2%, we're not doing anything. It has to be substantively above 2% for Fed to start hiking. Let's say like this, right? Now, how far can we hike past that to really make you lose money? So, and I'm not talking about where it's going to go on mark to market. Bonds can go anywhere on mark to market. That's just an asset. But if you call the 10-year from here to maturity a negative 1% yield, I don't see many scenarios of losing money.
The market would tell you the other one. Everybody would say you're crazy to say that because they assume that structural inflation is higher than that over the longer run. And you're saying bonds are kind of fairly
fine,
high.
So it's higher, so I'll be earning higher inflation. I'm going to earning inflation minus 1% and funding it at federal funds rate. Now, it just sounds crazy. Why would I own an asset with negative 1% yield? But what if the funding cost is negative? Currently, the funding cost is negative 5% because they have 5% inflation and zero funding cost, right? So I'm getting negative 5% funding cost for this asset. And I think it's going to go to probably negative 1.5 to negative 2% in the future. What I think is going to happen, and it goes back to my inflation view, I think we did have a high inflation. We had a huge jump inflation in 2020. And in my uneducated layperson's view, what's going to happen now, we have a very high base effects. And as the supply pressures will work through, we will be starting from such high levels that inflation will start looking again like 2%, which will actually mean very high average inflation if you count in the jump of 2021. But it will not look like you need to do anything because it will be moderate for a while. That's my point.
It reminds me a little bit of the 40s, which started a similar way. There was a huge amount of stimulus, the 1940s. Interest rates went up to, inflation went up to 6% or something like that. And then it came off. The year-on-year base effects wore off. And contrary to what everybody's expectations would have been, with big stimulus, both fiscal and monetary, inflation stayed at like 3% back then, which, so I kind of agree is, yes, you might get this higher level of rates, but it doesn't feel like we can generate proper structural inflation here.
Well, I don't know if anybody actually wants structural hyperinflation. People just want to have target inflation, and I think it probably will generate it, but I don't think that will make the Fed be too much in a hurry to raise rates. And again, and if they do, I think it will probably short-lived again.
Yeah. So, okay, so we've talked about bonds, which is, you're relatively constructive, but no big trade. We've talked about the dollar, not much to be doing, precious metals. So how do equities fit into your equation? Because a lot of macro people have started switching their focus towards equities because it may capture more of the macro views. How are you dealing with equities and what are you looking at?
Well, equities, honestly, to me, are very strongly caught in inflation dichotomy. And there is a camp of people, and I'm sorry, in a sexist way, I call this camp the grumpy old men, but there are some very respectable women in that camp. So, which I would love to debate. I just don't want to right now bring up names, but there are some women I would love to debate in that camp too. So, who love precious metals, who kind of think that equities are way, way overvalued. And they think that there'll be no inflation, the kind of deflationary collapse is more likely than inflationary collapse. And this is the camp I would like, and hence that title, right? Like people kind of very skeptical of everything, right?
I see that camp a lot.
Yes. I respect this camp because they have actually a lot of education, a lot of good arguments. There is a contradiction from my perspective in that view, because I feel like if you call it deflationary bond view, you basically cannot have a negative view on equities. Any argument that equities are overvalued to me becomes meaningless if you stick to negative real rates, because assets with even with zero real yield, become very valuable in the environment of perpetually negative real rates. Now, notice in my scenario, I didn't discuss like inflation actually going really negative. I just don't think it's gonna very likely to happen in this environment. I think that there is enough stimulus coming in to fight that anyway. But for as long as the deflationary environment, central banks will keep supplying money. Why wouldn't they? People are taking their money, which is free for them to make. I like to think of central banks as just market players whose product is money. So they're going to keep supplying the money for as long as people are taking it. And they will supply it till it'll become excessive, and eventually people will stop taking that money in exchange for assets. I think we had this conversation before. So it's not that the assets will become better, it's just money will, in deflationary scenario, eventually money will be no good as an exchange media for assets. The money will be good to pay rent, to buy your food, but it's just not going to be any good for assets in deflationary scenario, because in that perpetual zero rate environment, it's just very hard to find a cap on asset prices. That's my argument against that term. But this is a very long, again, kind of meta argument.
Also within that is, there is a put that's been purchased by the Fed on our behalf at somewhere like down 15%, and that changes the risk reward of equities. And it's been very clear now that the Fed won't allow equities to go lower in value significantly over time. So they've basically capped the downside for us. So it makes being a buyer of the upside of equities clearly a more superior trade now than the old macro trade of trying to short the highs.
Now, being the devil's advocate here for a moment, I am not so certain that we'll have a 15% put, because the traditional measures, we don't know how the next equity crisis will develop, and traditional measures of the Fed might be not as relevant to it, because, like, say, cutting rates, where do you cut them when you're already at zero, right? And even supplying liquidities, the nature of the crisis could be such that they might not be able to stimulate right away. And to be devil's advocate about equities, I'm actually not a fan of huge equity allocations right now, not a fan of that, believe it or not, because I'm kind of going back to the argument I was making in 2016, 2018, somewhere around like maybe close to those years. Several times at conventions, I said, hey, let's raise hands. Who thinks that we're never going to be able to buy equities cheaper than they are today? And nobody thought that we would never get them cheaper than they are today, right? And it's like, then why are you long equities, right? Why are you all in equities, right? If you think that at some point in the future, if you're certain they'll be cheaper. The trick was always, that was the case like in 2006, that was the case in 2018. It looks like equities can go only up, and then something like COVID happens and you get that moment. I think many people prefer not to tempt their fate that way because they don't know if they have the courage and the conviction to buy them when March 2009 comes or March 2020 comes. Now, my strategic system precludes me from not buying them. It's absolutely impossible for me not to buy in such a scenario.
And why is that? Explain that.
Well, you need to move from bubbles to scarce assets, right? So what happens in 2009, cash becomes a bubble. So everybody sells everything, cash is the bubble. You know that cash will be added by the fact that liquidity will become excessive. Over the long run, you know that assets have to go up. So the long-term trade is to buy assets. There is no choice. And again, like just the way I structure my trading, I'm not allowed to chicken out. I'm not allowed to say, this is, if I had some levels to buy, I have to buy regardless of the reason things get there.
So you think currently that the risk reward is not clear in equities then. So therefore you think there's probably downside to come, don't know when, and therefore it's not worth buying yet.
It's always like this time could be different, but my almost 25-year experience in the markets tells me that there will be a cheap, basically whenever we make decisive all-time highs and run up like 20 or 30% from previous peak, it has been always safe to assume that it'll probably run a little further than anyone can imagine, but there is also something will happen to make you buy it cheaper in the future. So that's why the long-term argument for asset prices is strong. One thing that could break this argument, again, if the moderate inflation camp, like myself, is wrong and inflation will get really high and Fed really will have to stomp it out, seem like the situation develops like in 70s and 80s, like we could have a serious negative, like if Fed has no choice that to be stomping out inflation, that would be a very serious negative for stock market. Even if real rates will not go high, because say inflation running at 7%, Fed has to go to 6%, I don't think that will be great for stock markets. So that environment could have and if they really have no choice at that point, this could be a very negative scenario for stock markets, but it could be something else entirely, and it could develop in zero rates environment, and it could be a political shift in US again. It could be something entirely it could be geopolitical crisis. Again, if there is a development, for example, a China-related geopolitical crisis, and it causes the stock market sell-off, there is only that much Fed will be able to do immediately in terms of providing liquidity. And again, eventually it'll probably be good for assets, but in a situation like this, but just experience shows that something happens every 3 or 4 years. So 2020, we're due for something in 2023, 2024.
Yeah, I struggle with I want to be long equities, but I just can't get there because same thing. It feels that there's a sharper sell-off to come because volatility has been kind of crushed and leverage gets into the system. And then whatever the tipping point is, some reason it creates the sharp sell-off. And it feels like you really want to buy that than by momentum, I think.
Well, there is one magic rule. I think I mentioned it before. I've actually written about this in my first book, in The Next Perfect Trade, in 2014, 2015. And since then, it continued to work like magic. And that rule actually tells you that you're still safe with equities. Look at the 10-year yield today. Look if it's higher or lower than it was 2 years ago. And if it's lower today than it was 2 years ago, you can buy equities.
Interesting.
Like, think about this. 2016 Brexit, buy equities no matter what, because the yields will, like, no matter what was happening with politics, with Brexit, whatever, buy equities because rates are, like, even if you go a little further back, 2013, 2014, rates went up, and we had trouble in 2015, 2016 with stock market 2 years later, right? Rates in 2014 were higher than they were in 2012. So 2 years later, we're having troubles in 2016. 2016 rates are significantly lower. Buy stock market, you are safe. 2018, rates are higher than they were in 2016. We're heading for a period of troubles, including 2020.
So using the 2-year rate of change, you can pretty much figure out whether there's going to be a problem or not.
So 2-year backwards on interest rates gives you 2-year forward on stocks. Incredibly robust rule. Very silly. I think it just has to do with the reason why it's so strong is kind of captures the typical rhythm of business cycles and like rate cycles in the US. And I originally came up with this for 2 years, and then we tried to calibrate it and see if you can do any better than 2 years by changing periods. But 2 years seems to be the best, which was what we started with. So it was not a calibrated to 2 years. We started with 2 years, and it turned out to be the right cycle length. And so right now the rates, I think, still a little lower than they were 2 years ago. So we're kind of still safe. But we're going to be grinding into unsafe zone as we will be going into 2022 and beginning to correspond to really low rates in 2020. Now, unsafe zone does not mean that equities always go down, because they go up more often than down. So, but what was true for the last several decades, that with only one kind of exception, and you still were okay to buy equities, but the thing is, like, if you bought equities in 2008, rates were already lower, but you're still heading to a really big sell-off into the beginning of 2009. But of course, so you wouldn't recover by 2010 immediately if you bought it at a bad time in 2008. But eventually, it would still be a good buy in 2008, right? It's just like the timing wouldn't be great. That was one exception. Otherwise, last several decades, this rule would have been very good in terms of rates are lower. Okay, to hold on to your stocks.
So where else are you interested in allocating risk? Where are you with crypto right now? Because you've been in the crypto markets personally for a long time, kind of passively. How are you thinking about that in your strategy nowadays?
Kind of the same. I'm not a crypto expert. I have not been holding any crypto for investors. I felt that I'm not charging my fees for being custodian of their crypto. What I've done, we have created now the capacity to trade crypto within our funds in case we see opportunities. Because I feel that there is two different things. There is like a hodl approach, or you can have a part of your macro portfolio approach. Because I talk a lot about being long term, but in the end, I'm still a trader. My objective is to buy things low and sell them high. Not index something and hold to like I'm just holding Bitcoin. Right? I feel like you don't need to charge clients money for that. They can do it themselves. Everybody can make their own choices. So that's kind of my business-like approach to crypto. If it becomes a part of macro portfolio, if I can see how to play it against other assets, if I see I can gain an edge, I will trade it. Overall, I probably lack the strong conviction that you had and did so well with. And I always give you a lot of credit I give you credit for changing your conviction a couple of times. But having like the courage to say, okay, I was wrong a couple of times, switching around and then getting on the right train. That's one of the first things I learned. One of my friends back when I started working on Wall Street. It's like a trade is like you're standing on the platform, you miss the train left, but there will be next train. Don't give up.
That's right. You just need perseverance and patience. Most people lack patience in financial markets. They want to do a trade. And every time I talk to you, you never want to do a trade. You wait for the right setup to do that trade. And that's a key thing, I think.
Yeah. So with crypto, I really think the risk reward is still there in the sense that the downside, obviously it's like hard to tell people go buy Bitcoin. You could buy it for 10 cents in 2010 and now you have to pay $45,000 for it. Same could be said though, but the same people have no compunctions about holding Apple or Amazon.
No, that's right. And they're very similar attributes. They're those exponential charts that you need a log chart for. And if you hold them, they work.
Yes. So yes, at some point, Apple was in the garage, right? And Google, you probably could buy Google for $1 million at some point, and now it's $1 trillion, right? So same thing with Bitcoin. It did earn certain amount. Bitcoin and other stronger cryptocurrencies earn a certain amount of street cred, which makes it less likely that they just kind of die out by themselves. You still have all those regulatory and other vulnerabilities that a lot of people talk about, and I'm very appreciative of that. I'm not so afraid of central bank digital currency thing as a competition, because I feel my bias, and it's just my bias, very uneducated, is that if central banks issue digital currencies, it will be, to them, Bitcoin will be like gold is to fiat now. So say, for example, if central bank digital will just be the new form of central bank fiat, then Bitcoin will be just the new gold to them. Because again, no matter how central banks of countries handle the digital currencies, there will be some people who want to see, like, we want to have some kind of medium of exchange which is not specific to any central bank, and that's kind of how precious metals act. I think that's how probably Bitcoin will act, and Ethereum will be kind of still digital copper or digital silver, if you want something in between those things that is both has industrial use and a money storage use. They're probably kind of flow in between. Can they make them illegal? Or I'm worried about security in the blockchain, and I'm worried about clunkiness of security still a little bit on crypto. Because the things that people say, like, oh, that's very easy. Remember 30-word song to remember your password, write it on 7 pieces of paper, put it in 7 safes in 7 different countries, and nobody will ever hack into your wallet, right? And you say, like,
yeah,
it's not manageable. And to a large extent, it's like you cannot put too much of your assets on the stuff because it's like carrying a lot of cash in your wallet. And then people say like, yeah, check your wallet all the time, don't lose it. But so institutional custody is like, well, like now we can operate because there is some institutional custody. But I think security issues for individual security of blockchain is still a big issue. And we do see various breaches. I don't know, like you always have to worry about quantum computers and all this other stuff, how it will all play out. You can worry about like 51% attacks or some like government players sabotaging blockchains. Could happen. I don't know. To me, like the risk reward is there because you can topple. It's like anything else. It's like what I'm talking about silver. Yeah, it can go down or it can go up, but it can still triple. So it's a good proposition. So I'm okay with people who think they want to hold crypto or hoping to increase it several more times.
Yeah, the risk reward, even if it goes to zero, considering it's grown at 213% a year or whatever the number is, it's the risk reward still stacks up. And there'll be points where it'll get excessively speculative and it won't look as good. But it feels to me that as a macro trend, it climbs the wall of worry of regulation, the wall of worry of 51% of tax. And that's a very healthy bull market when it climbs a wall of worry.
Yeah. It would be very hard to tell at any given point, I think, oh, this is it. It's got to the fair value. Let's take profits. I think there will always be an element of Pascal's wager in it to say, hey, do you want to have at least a little bit of crypto on you? Because if that is the only thing that will survive and fiat will collapse, do you want to be holding the bag?
Yeah, true. So, and you own it personally, right? As I do, because it has great attributes for this world that we're in, the same attributes that gold has in certain extents, and also, as you said, as central bank digital currencies come, it just makes it easier because it kind of integrates with the system.
Yeah, I don't think central bank digital, like my opinion is that central bank digital currencies are not at all a problem for the decentralized crypto ecosystem. I think there's a lot of money in the world, and I don't think that all of it has to be Bitcoin. But if Bitcoin is worth $1 trillion, there's space for it to be worth $5 trillion without world dramatically changing. Now, if people thinking of Bitcoin going to $100 trillion market cap, that's a different world we're living in, right?
Yeah, I can see that certainly for the entire crypto space potentially. And who knows? There's a probability. I can't assess the probability of Bitcoin getting into $100 trillion. It would, as you say, it would require a very different world for that.
But the world in which it's worth $5 trillion is basically not that different from the one we live in. That's what I'm trying to say. There's a lot of world. Really, that's what I'm saying. Like a lot of people are like think that fiat is heading towards collapse. And I was like, well, if it's heading towards collapse, why people are so eagerly taking this cash from the banks, from central banks? And to me, the fact that central banks' balance sheets are so big actually insurance against collapse of fiat, because all they have to do if it starts collapsing is sell those balance sheets and take it back out of the system.
Yeah, that's true. Although if assets are being denominated in fiat, then when you do that, you drive down asset prices.
You do, but at some point, that's a price that's like a feeding Sherlock kind of moment, right? Yes, if central banks sell assets, that's how you tighten. That's what you tighten monetary policy for. You have to stop like if they have no choice, it's going to be painful, and that's why you don't want to own assets if hyperinflation is an issue. But if they feel like they need to do something about hyperinflation, I'm just saying they have a lot of things to do. Asset prices will probably go down if they have to sell them. And some of the banks, Fed just owns treasuries and mortgages and stuff, but like S&B, for example, or BOJ own actual stocks and ETFs and things like this. They're going to start selling them. They're going to go down.
Yeah. So what else, just to wrap up here, what else are you looking at that you don't think anybody else is really focused on? Something that you're thinking, yeah, this is interesting to me, whether you're in a position or not, but something you're doing the work on and thinking, this is something that interests me.
I think that there are some opportunities for people who have like structural capacities, like we do to do slightly more complex trades, to make bets on higher rates in a stealth way, to put on trades that make without actually having to be short bonds directly and earn negative carry. There are some structural bets in the asset swap space which benefit when rates actually go higher. And that is, for me, an interesting subject to explore. And one of the most my trades I'm most fond of is the municipal asset swaps, municipal index swaps trades, which basically it's very hard to explain the mechanics in a short way, but the rates go high, you have extending duration and the thing goes in your favor. So the convexity, it's a weird trade in which, very rare kind of trade in which typically when rates go up, your trade actually becomes larger size. But like if you do this in mortgages, you're actually losing money when you do it in municipal swaps, you're making money when rates go up, typically. It's not guaranteed, but that's how the structure of the market works. And your trade becomes bigger. So that's an interesting opportunity. And meanwhile, it just kind of carries a very low positive carry. However, it has its problems. It's like it has positive beta, it's crisis vulnerable, it's illiquid. There are all those ties up.
But in context of the rest of your portfolio, which is generally not betting on rates rising significantly, it has nice portfolio effects.
For example, my portfolio was under pressure this winter, and that was the only part of my portfolio that was performing. Like when there was a big sell-off in the winter, that was the part of my portfolio. It was small, it was not offsetting at all other problems, but incrementally, that was the performing part of my portfolio in January, February. So yeah, it's very interesting. I love putting trades like this, kind of stealth trades, which is probably not going to do very much until rates actually start going, actually Fed starts hiking, and then you could get good P&L there. But you kind of really have to understand what you're doing there. You're also vulnerable to tax policies. I'm making an assumption that taxes will not be cut in the United States because the trade benefits when taxes are higher. Right. Again, you can go into structures, but because it's tax-exempt securities.
Fascinating.
So what I'm saying, like, it's interesting to go sometimes right now nitty-gritty and find if you can find some opportunities which are counter to your central view, but not actually costing you money that you can kind of put just in case in your portfolio.
Yeah, I love that because it just gives you an ability to hold your other trades longer with more comfort. As you said, it's not a perfect hedge and you're not trying to make a perfect hedge, but it gives you some optionality should the regime change. Brilliant. Alex, as ever, fantastic to talk to you. Lots of interesting things. And I guess we'll just have to see. It feels like we're still in a bit of uncertainty around now, and many of these trades, the macro trades, aren't really doing a lot yet. But that time comes. We just have to be patient.
Yeah, this year definitely calls for patience. I think this last several months, kind of, no matter what views you had.
Yeah, long rates, short rates, everything. I mean, nothing's gone anywhere. Copper's gone sideways. I mean, everything it's not been an easy market, but things change. They will change.
Yeah, well, it was a pleasure as always to be on your program, and good luck.